on the banking industry and whether it can return to pre-crisis levels. We're joined by Dan Alpert. He's the managing partner with Westwood Capital. Dan, good to have you on the show. Thanks for joining us again.
Good to be here.
Dan, how has this increase in banking regulation impacted the operations of the bigger banks?
Well, I think it's important to sort of bifurcate the question into two. One is, it's a very difficult time to be a bank anywhere.
Right.
There's very, very low loan demand. Interest rates are extraordinarily low. And so a lot of the bottom line you're seeing eroding is just due to fundamental macroeconomic factors. On the other hand, obviously, there's been an enormous number of additional regulations imposed on the banks, many for very, very good reasons. What's very interesting over the last year is a year ago you were seeing banks really making progress, especially on the Republican side of the aisle, with pushing back against the regulations. Well, the bureaucrats in the regulators didn't like that at all. And so what's gone on over the last several months is you've seen the bureaucracy push way hard in the opposite direction. And so the banks are not going to be able to make the type of recovery from the dodd-frank Act that other people thought that they would.
It's about striking a balance of, we had too little regulation before, and many say we've gone to the other end of the extreme and we have too much regulation now. And if you look at the fact overall revenue has stopped growing for the first time in decades for banks, some has even declined. There's been a major drop in profits. Some have managed to stay profitable, mostly thanks to cost cutting and eliminating units and eliminating staff. So have these regulations gone too far? Are we killing Wall Street?
You know, I don't agree that we're killing Wall Street. Again, you can't conflate these two very distinct issues. You know, commercial banking on Wall Street has really been the mortgage business. And the amount of mortgage lending, you look at any of the recent statistics, has gone down, not because banks have tightened credit over the last year, but because the demand for credit is so low. The mortgage refinancing boom that happened after the crisis fizzled out.
Right.
The volumes that are being done in the mortgage industry are not as great as they were. And on top of that, the one area of regulation that does put a great crimp in bank activities is the CFPB, the Consumer Finance Protection Board. They have actually created a work environment for the banks that is very dramatically different from what existed before. And banks do have a lot of costs associated with that. Right. So, yes, expenses have gone up in compliance for sure, but I think that can't be really conflated with the top line, which is going down for different reasons.
Dan, some would argue that these compliance and regulatory measures have really also attacked the smaller community banks, and they've sort of been caught up in the whole attempt of preventing too big to fail, but that it's actually backfired because we have these community banks that are not able to maintain the costs. And according to the Harvard Kennedy School of Government, the number of community banks has fallen 40% since 1994. Their shares of U.S. banking assets is down to just 18% from 41%. And that the majority of this decline happened not because of 2008, but after dodd-frank was enacted, and that they've lost revenue, and the rapidity in which they losing revenue has doubled since then. And in a way, that's making the bigger banks bigger again and giving them even more market share. So has this backfired in we're getting too big to fail because the smaller guys can't keep up?
Well, there's no question that that's a factor. I mean, you have more than half of all deposits in the United States in 4 banks. So that's a situation we never experienced before. And you're absolutely right. After the crisis, this crisis brought on by the largest financial institutions, our largest financial institutions got larger. As a small broker-dealer in the securities industry, I can tell you that our compliance costs have gone up enormously since the introduction of dodd-frank. And yes, that puts a crimp in our bottom line. But at the end of the day, and the same thing is true of community banks. At the end of the day, however, again, much of that is consumer-focused compliance and consumer-focused practices. And so you have to take the good with the bad at some point.
Well, Dan, some are saying that the banking regulations are actually pushing people and small businesses into darker areas. The payday loans, the peer-to-peer lending, because the big banks aren't interested with interest rates so low. The community banks can't really help them out. And so they're being driven into darker waters, if you will.
Well, you saw something happen in 2014 that was very unusual given the last several years of history. We had an enormous explosion in consumer borrowing, but it was almost all concentrated in student loans and auto loans. What we saw for the first time since the crisis in 2014 was an increase in revolving credit, and revolving credit are credit cards. And the number of credit cards issued to people with poorer credit has gone up. So yes, there was for a while a great deal of pushing into the shadow sectors of payday loans and what have you. But we've actually seen that statistically reverse over the course of last year.
All right, Dan, I understand the thinking behind stress tests for the really big banks, but now we're having regulations imposed on the 10 to 50 billion cap. And a lot of these banks are just saying, well, we don't want to grow beyond that market because then we're going to be subjected to all of these costs. So at what point are we holding back business?
Well, again, if you had creditworthy loan demand that wasn't being fulfilled, then I would agree you were holding back business. But unfortunately, if you look at the size of bank reserves today, which are astronomical in comparison to any point in history, the unlent cash, so to speak, you're looking at an environment in which end loan demand just isn't there and hasn't been there for some time. Sure, if I said to you, by the way, would you like to borrow $1 million? You would say, yeah, I could probably find something to do with $1 million. Would I, as a bank, likely get that $1 million back? I know they pay you very well here, but nevertheless, I don't know.
Not that well, Dan. Not that well.
I don't know that that's a good thing to do, but that's what banks were doing back before the crisis.
Okay. Well, thank you, as always, for your insight. Dan Alpert, Managing Partner with Westwood Capital.